So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
I'm not alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me. And I go, "How long is your time series?" And I go, "Oh, we took it back 5 years." I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, everyone's like, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So we're down. Nasdaq's down, bounced back a little bit in recent days, down close to 30%. Down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. 41. Actually, it was 1981 before we saw these numbers. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. It wasn't the beginning. It's like, that's some inflation. Yeah, we did, but it had started. I mean, some ways it started in 1968, and it really took off in 1974, 75. So 81, these numbers, that was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50 in that 5-year stretch. So you were putting up numbers, 10%, 11%, 13% and higher year after year. Yeah, 1981, it was 9 or 10, which is what they're comparing it to today. But that was on the downslope. It had been higher than that in 77, 78, and and 79. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the 40-year comparison, it is correct, but that was the tail end of an even worse episode. And again, there is this comparison to the 70s. By the way, I think the situation we're in today is very different from the 1970s, and I'll explain why. In the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but in percentage terms, that's a huge jump, but it was still $6. And then it got to 12, and then in 1979 you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. The Fed will not be able to get interest rates to 5% without causing recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic, and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did. And the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973 after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. Now, I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You're talking about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.
The narrow focus I'd like to start with, since it's the topic of the day, is the dollar. And, I'm going to throw red meat to the wolves here by citing a headline across Bloomberg earlier from Larry Summers talking about how the dollar can continue to move higher because the U.S. has all these great fundamental advantages. This comes, 24 hours after another Bloomberg headline talked about the unstoppable strength in the dollar. So there's the red meat for you, and I'll let you gnaw on that for a little bit.
Well, it may come as a surprise. I think Larry Summers was half right, and I've met him a number of times. He's a brilliant guy. He's always, I almost always agree with his analysis and then disagree with his policy. So I always have to stop halfway with Larry Summers. Like, good analysis, Larry, but you're going the wrong way. But yeah, I think he's right that the dollar will get strong. Is probably correct. Also, where I disagree, and this is critical, is the reason why. The dollar is getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. So let's just maybe step back and not be Larry Summers for a minute, but just be everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. economic growth is incredibly weak. So we've got sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table? 130%. The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. And
this is like the scene from Animal House. Would you like to meet Clayton, Jagdash, and Muhammad?
That's a good comparison. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. But we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number, but they don't guess at the stuff they don't have, and it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 0.2 or 0.3, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP sky high, economy weak at best, probably out of recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce.
Yeah.
That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs. But if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, I forgot the deficit, where, the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act,
Right.
and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion.
Yeah.
2 for Trump. That's 6 on top of 2 baseline. That's $8 trillion in 2 years. So your deficit's out of control, and your trade deficit's out of control. So what's not to like? And yet you look at all that and you say, "What? Are you kidding me? I mean, get me out of the dollar. Go get anything else." Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up and coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. So I'm like a 27 or whatever, a 28 maybe year old lawyer, but I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie, which I highly recommend. Chris Christopherson, Hume Cronin, and Jane Fonda. It's called Rollover. And it's, again, 1980. But All-Star Cast, yeah, I got a murder mystery, a little sex thrown in, but it's basically about the collapse of confidence in the U.S. dollar. And Hume Cronin plays the Walter Wriston part. And basically the idea was, remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course, he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. If one of our supply chains or one of another country's supply chains that we rely on collapse, it could cause an unprecedented economic super collapse on a global scale. And that's how we could end up with this $85 trillion economic super collapse I'm predicting. $85 trillion being the value of the global economy. Because remember, our current supply chain is interconnected on a global scale. And if there is a single point of failure, the whole system is going to come collapsing down. Farming, banking, healthcare, oil and gas, tech, and so on. This isn't the first time I've warned Americans about this before. On May 11th, 2020, I told my followers, the economy will not return to normal for years. There are serious constraints on supply. I issued another warning about my research on November 24th, 2021. The supply chain difficulties will certainly grow worse. The remedies will take years and sometimes decades to implement. And yet another in 2022. Don't believe the happy talk about a temporary supply chain crisis. I'll say that again. The crisis will last for years with predictable negative effects on economic growth. But now things are even worse than ever before. And I fear this economic super collapse could hit American soil in the next 6 to 12 months. So this may be my last and final warning before it's too late. It's why I'm warning people around me it's only a matter of time before the world economy comes crashing down. Because when you talk about risk of catastrophic collapse, the risk increases with the size of scale. Look, whether you decide to listen to me today about how to prepare, whether or not you decide to get access to the information in this envelope, that's up to you. It's a free country. You can do what you want. You can even pretend you never heard me tell you any of this. But just know, Joe Biden certainly isn't going to come to your rescue. Take a look at this 9-second clip from the president.
When do you think things will get back to normal?
When do I think things will get back to normal? But my hope is by this time next year, we're going to be back to normal.
That clip was taken over 18 months ago. It's up to you what you believe, but I can't bury my head in the sand and ignore all the facts, and the facts couldn't be more clear. So in just a moment, I'm going to explain how you can get access to this information inside the envelope as part of my super collapse preparation package. And I'm going to talk about what to do to protect and even grow your wealth. Look, please understand, it brings me no joy to say this, and I hope the worst of what I'm warning of never comes to pass. But there's only one potential solution to this crisis, and it's going to take years. Recently, I spoke to a very well-informed CEO of a major corporation, and I asked him point blank, I said, your company must be looking ahead of some possible solution. Is there anything you can share? Well, I'm going to tell you the same thing he told me. He said, Jim, you have to understand that it took us 30 years to build these supply chains. We blew it up in 3 years, beginning in 2018, and you can't put it back together. But there is one thing we can do. It's not a quick fix, but it's our best and most sensible option. Our only way out is to build a new supply chain that eliminates the bad actors. We can't continue to allow our enemies like China or Russia or Iran to threaten consumers here on American soil. As the Wall Street Journal wrote, Russia's lengthening war with Ukraine will lead to a near doubling of inflation rates in rich countries. It's why the New York Times wrote, this is what happens when globalization breaks down. And why Barron's wrote, secure U.S. supply chains with allies and move out of China. Unfortunately, this solution could take years or even a decade to fully implement. And that CEO told me it will take at least 10 years to reconstruct the supply chains if we don't want to do it with China and globalization. But whether you realize it or not, that's the bet we're making as a nation. It's happening now. And when the dust settles, we're either going to have rolled out this new supply chain before worst case scenario happens, or we're going to face whatever lies ahead from this $85 trillion economic super collapse. Now maybe you're wondering how bad things could really get. Let me answer that question with another question. Do you remember your life at the beginning of the pandemic? Despite all of our freedoms we all hold so dear, an unelected official with the ear of the president recommended immediate lockdowns, and suddenly we heard demands like shelter in place or stay at home, backed up by the threat of arrest. Large swaths of the economy ground to a halt. Looting took over our towns and cities. Because so many businesses were shut down, people were emboldened to take to the streets. But if most Americans don't have access to enough food, water, or other necessary supplies, do you really believe our streets and our businesses won't see more violence? It's why gun sales keep hitting all-time highs as more and more Americans prepare for whatever lies ahead. And while I hope the worst of what I'm warning in my urgent new book never comes to pass, I don't suggest you rely on hope to protect yourself and your family. I'm certainly not. Here's how I'm ensuring my family's well-being. First, I would suggest stocking up on essentials, just like I've done. I have a fully finished area in the basement of one of my properties, the address of which I keep totally private. It provides me with a warehousing area for months' worth of canned foods and other non-perishable provisions. That's important. Don't stop with a 3-day supply like the CDC recommends. Make sure you have enough water, basic food, and toiletries to last at least 3 months. And keep them in a safe area where they can sit without damage or spoiling. I would also recommend buying several large capacity freezers. I already have 3 and I may continue purchasing more. If you have the means, consider installing alternate energy solutions in case of a worst case scenario. I've already installed the largest non-commercial solar power system in New England on my property. If you can, have alternative sources of power generation on your property. I've also dug 3 wells, planted abundant gardens, and built a significant greenhouse. But whatever you decide, do recognize that none of it will matter if you're not getting accurate information about what to expect in the coming days. Like I said, to be able to make the right decisions during a crisis, you need to lean on someone. So if that's not me, you should find another well-connected person you can trust, ideally someone who's previously held a position of power in our government. But if you want to learn what's inside this envelope and see what I know, right now is your chance. See, I've gone ahead and published this information I'm holding here in this envelope inside my newest book. It has brand new proof of the unfolding situation and inside level details on how it will play out. Urgent Preparation Report number 1. Buy this asset after securing your family's food and energy. As the economy collapses and the shelves are bare, the government will respond by printing even more money. When it does, the value of the dollar will be destroyed through inflation. But 5,000 years of history proves that one item, gold, outlasts every other currency as a form of money. And I believe that the economic collapse occurring right now will send gold skyrocketing over the next 6 months. That's why I'll send you my urgent report called The Perfect Physical Gold Portfolio. Everything you need to know about buying the right kind of physical gold. As part of my super collapse preparation package, you'll find everything you need to know about investing in gold before the price blasts through the ceiling, including, is gold safe to invest in? How much should I invest in precious metals? What metals should I buy and what should I avoid? What are the best places to buy gold and other precious metals? What are the safest ways to store gold to avoid theft or government confiscation? And much more. Plus, I'll also send you Urgent Preparation Report number 2, my Biden Bucks Protection Plan. I haven't mentioned it yet, but during my research, I came across a troubling executive order that President Biden just signed. See, every time there's an economic crisis, the government responds with massive new programs to try and control the economy and its citizens. In 2008, it was bailouts of big banks and new government agencies to regulate the financial industry. This time, it will be much worse. I've uncovered a plan for U.S. government cryptocurrency I call Biden Bucks that I believe the government will unveil during this economic collapse to control your money and manage the societal fallout. By the time this program is announced, it will be nearly impossible for everyday Americans like you to protect their wealth and keep their privacy, which is why I've created another urgent report to get you prepared ahead of time. Inside this new report, you'll get step-by-step details on what these Biden Bucks are, why they'll be used during this collapse, and how to outsmart this sinister program by creating, 1, an off-the-grid fortune. Secure $1.1 million in wealth inside a soda can safe. 2, saving your freedoms. Have liquidity and spendable wealth without using Biden bucks. And 3, growing your personal wealth. You'll get possible investment upside as events unfold. And 4, ensuring you maintain your wealth regardless of external conditions. Building your own off-the-grid portfolio now will protect you from the government surveillance state coming during the economic super collapse. Biden bucks testing is underway. The digital dollar could be rolled out soon. Before it's too late, make sure to protect yourself and your retirement savings. You'll find everything you need in this urgent report as part of my super collapse preparation package. But that's not all, because you'll also get urgent preparation report number 3. Secure this secret off-the-grid asset. You see, I've learned of another little appreciated asset that's a liquid form of wealth. It can't be tracked or traced. It's completely legal and easy to find if you know where to look. Over time, its value has steadily grown, but very few people know anything about its investment potential. You're about to be one of the few. I believe you must include this secret asset in any off-the-grid portfolio. We're in a recession. I mean, it's not coming. We're in it. It's a triple, greatest bubble of all time, times 3 in the sense that it's real estate, stocks, and other asset classes. The largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates, but then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance. I haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is going to play out. It'll get worse as the year goes on. Inflation was going up long before the war in Ukraine started. So if everything is great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, 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 and then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. This is going to be part of what throws the economy into severe recession. They're raising rates and inflation is coming down. But what they don't know is, are interest rates coming down because they're raising rates, or have they already hit the terminal rate and it's coming down on its own and they just don't know it? And that's a big deal, because if they're at the terminal rate and they just don't know it and they keep tightening, which they are going to over tighten, probably already have. The energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year. The other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So inflation is coming down, no question. But is it because the Fed has continued to raise rates, or is it because the Fed has hit a terminal rate and all they have to do is nothing, just pause, as they put it, and inflation will come down where they want? The market believes we're at the terminal rate. The Fed should just stop right now, leave it alone. Sooner than later, pivot to, that's the new buzzword, pivot to rate cuts. And it's the anticipation of those rate cuts that has Wall Street all spun up. They get the pom-poms out and saying, buy stocks, buy tech, because the Fed's going to cut rates. The Fed does not see it that way at all. The Fed says, yeah, we're raising rates, inflation's coming down, but we're not at the terminal rate. We'll kind of know when we see it, but they think it's probably 5.25. That's a very good estimate based on what the Fed has said themselves. I started my career in banking in 1976, and so I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every like 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed whatever, a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. During the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time, but it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because it's precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially. And the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, hey, better spend the money fast because it's losing value. This damage was self-inflicted, but don't be misled by the headlines, because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin and everything to do with the U.S. handicapping its own energy industry, begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon, because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. I'd rather be the U.S. than China. China's in even worse shape for different reasons. It's not so much interest rate policy, although they're subject to global interest rate policy and exchange rates coming from the Fed. But you can see it in real estate. It's a full-scale collapse. They're propping it up, but the buyers aren't interested. In other words, the Chinese government is telling the banks to lend money to real estate developers who can't finish housing. Well, that sounds good. It's like, okay, here's some money, finish the housing. But the buyers are not flocking in. The buyers have been burned. They're shying away from that asset class. They want to increase cash. They're looking at other asset classes. They don't have a lot of choices because China has very strict capital controls. They're trying to get their money out by means legal and illegal. They're buying gold when they can. But as I say, they may not have a lot of choices, but even money in the bank looks pretty good compared to what's going on in real estate. The problem is too big. The bubble is too large. It's gone on for too long. We don't hear about it the same way we did about the Japanese real estate bubble in 1989, 1990. That was an epic crash. Japan has still not recovered. I remember in the 90s, early 2000s, they talked about the lost decade. Well, try 3 lost decades. That's going into a 4th. That's Japan, 8 or I've lost count, actually 8 or 9 recessions since 1989, but it's really just one long depression. That's the way to understand the Japanese economy. China's going into something like that. We don't hear much about it because they're not transparent. They lie about their numbers. You need to look at private sources and use other analytic tools to understand what's going on there. But they've got drops in consumption, industrial output, real estate's collapsing. Their price indices are collapsing. All this fear of inflation. It's been around. It's real, but it's now turning around very quickly. And you can see that in China. China's going through something that the world has never seen. They're going to lose 600 million people in the next 50 to 70 years. This is a demographic implosion. This is worse than the Black Death. Of course, the Black Death killed somewhere between a third and half the population of Europe in the 14th century. It was a good time for labor, by the way. The labor was so scarce that returns to labor went up versus returns to capital because there weren't enough workers. But that's the only thing that can come close. Even the Spanish flu of 1919 killed about, no one's certain of the number, but between 100 million and maybe over 200 million people. The 30 Years' War was certainly, in the early 17th century, was certainly highly destructive. But what's going on in China now is worse than any of those things. It has to do with math, simple demographic math. The key number is 2.1. 2 people have to produce 2.1 children. A man and a woman, or you can say per woman if you want, have to produce 2.1 children to keep the population constant. Why not 2? Why not 2 producing 2? The answer is infant mortality and those who don't make it to adulthood and can continue the repopulation of the planet, if you will. But they're not even close to that. They're well below 2. And by the way, so is the rest of the world. So is Australia and the US and Western Europe and a lot of other places. This is a global phenomenon, but it's particularly acute in China. It may be the case that China's replacement rate is or birth rate is actually 1. It has to be 2.1 to maintain. It could be 1 or lower. This is a demographic implosion unlike anything anyone's ever seen. It also has a dynamic. You can't reverse it very quickly. It feeds on itself, as I was talking about inflation earlier. So this is going to continue for 50 to 75 years. They're going to lose 600 million people. There are a lot of definitions of GDP, 4 or 5 part definition. There are more complex calculations, but there's one really simple definition. It only has 2 factors: population and productivity. How many people are working and how productive are they? That's nominal GDP. That's one definition of gross GDP or nominal GDP. Well, if your population is dropping from 1.4 billion to 800 million, you're losing 600 million people. And then what about productivity? Well, the other thing that's going on is China's population is aging very quickly. So you get a population of set people in the 70s, 80s, and 90s with very large amounts of cognitive decline, dementia. Obviously, there's no productivity there, but it's worse than that because then you look at the shrinking population between the ages of 25 and 54. It's called their prime working age. More and more of those people are going to have to be involved in elder care. They're going to have to be basically caretakers or caregivers for the older population I described. A very worthy job, but not one that lends itself to productivity gains. Bathing hasn't changed in about 5,000 years. Robots don't do baths. The only real innovation in bathing in between 1870 and 1940, we did see the rise of indoor plumbing and hot water. That's good. I enjoy both, but that's it. I can't think of any other bathing innovations in the last several millennia. So if you have a shrinking working age population, a rising older population, high degree of cognitive decline, and a big slice of the working age population having to provide elder care or be caregivers for the older population, tell me where your industrial output's coming from. Tell me where your productivity is coming from. And sorry if I mentioned this already, but 50% of the water in China is poisoned because of, just their industrial practices. If you're a gold miner in Australia, I invested in gold mines around the world. I know that places like Canada, the US, and Australia, if you use cyanide to leach the gold, and that's a very common technique, you have to account for every, microgram. Whatever you put in, you got to take out, weigh it, dispose of it properly. In China, they just dump it into the rivers, and so the rivers are poisoned. So China is an economic, demographic, industrial, moral, religious wasteland, and will suffer. It's already in a recession. Just to cut to the chase, again, they lie about their statistics. So here you have the two largest economies in the world, U.S. and China. U.S. is slowly going into what I expect will be a severe recession. China is in a century-long decline, unlike one that the world has ever seen. That could eventually lead to social unrest and a regime change, but let's not count on that in the short run. Just expect China to shrink and become more autarkic, decoupled from the Western world, and certainly not be a source of growth. Taiwan Semiconductor Manufacturing Company, the largest and most sophisticated semiconductor manufacturing in the world. And semiconductors are in everything. It's not just computers. There are 1,400 semiconductors in an automobile. There's a semiconductor or more in your dishwasher, your refrigerator, your washing machine. They're everywhere. Internet of Things. We all understand that. So TSMC, based in Taiwan. The United States has a military doctrine called the broken nest theory. And what it says is that if China, it comes from a Chinese proverb, ironically, and it says, if the nest is broken, how can the eggs survive? And what it means is that if China invades Taiwan, and I'm not forecasting an invasion, could happen though, we or the Taiwanese will very quickly destroy all the semiconductor manufacturers in Taiwan. We'll just blow them up. And China won't get anything. They'll have the broken nest. Taiwan Semiconductor knows this. They talk to the U.S. intelligence and military. Global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So there's a little bit of that going on. But in terms of the global economy, I think your use of the word global is very much on point, because we are going into, or may already be in, a global recession. Now that's rare. It's rare when, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. For obvious reasons, because, it affects basically everyone, but there's no life preserver. There's no, it's not like China's going to pull us all out of it with cheap exports, or Japan's going to, put the pedal to the metal in terms of fixed asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, that's pretty good. And, it's not good by post-1980 standards. It's not good at all by post-World War II standards, but post-2008, yeah, that's not bad. Again, you have to disaggregate it and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor. And fixed asset investment in particular, there was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. And this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumer slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring's styles. You still got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But, and natural gas prices skyrocketed and oil prices skyrocketed again in mid 2022. They've come down, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a basket case. They went from zero COVID. It was bad public policy and bad health policy, but they did it anyway. So they flipped almost on a dime. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected and we'll do the best we can. One of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. But the other difference between China and Europe and the U.S. is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. And I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then, there's what I call the reality. And I guess I'm a storyteller here, but, what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay. They're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but, rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, it's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about this. He was on the short list to be nominated to the Board of Governors in Washington to fill the seat that Lael Brainerd left. Lael Brainerd was a member of the Board of Governors. I believe she was vice chairman, but she left to go to the White House in the National Economic Council. She really is smart. She's a big brain. She knows what she's talking about. Very few of them do, but she's one of them. But she goes to the White House, but that's an audition for Secretary of the Treasury because they're going to throw Yellen under the bus. Yellen knows nothing. If Yellen were on this call right now, she wouldn't know anything we're talking about.
How is that possible, Jim?
Affirmative action. When she was chairman of the Fed, I said she was incompetent, and I was right. And then she became Secretary of the Treasury. She's a statistics geek from Berkeley. She's got a big brain. I'll give her credit on IQ points. So what? That's not the same as common sense or working knowledge or knowing how the street works. She's never worked, outside of government in her entire life. I don't care what your resume is. If you've never run a business, met a payroll, negotiated a purchase sale agreement, kept your morale up with negative cash flow. If you've never done any of those things, you don't know what it's like to be in the real world of the economy. She doesn't, but her specialty as an economist was labor economics. Okay, well, there's a place for that, but not as U.S. Treasury Secretary. You have to know she didn't know monetary policy of the Fed. She doesn't know fiscal policy of the Treasury. Knows nothing about international economics, and that gets us into the role of the dollar. She was like her husband won a Nobel Prize. Okay, George Akerlof. I know a lot of her close associates. If you don't want to say affirmative action, you can say the Peter Principle. Which, this goes back to the 60s, but the Peter Principle is you get in a bureaucracy and you do a good job and they give you a promotion. And then you keep doing a good job and they give you another promotion. And you keep doing a good job. And eventually you get promoted to something where you're incompetent. You're in over your head and you fail, but then you stay there because you're not getting another promotion. And so the result is bureaucracies are populated with incompetent people because they've all risen to their level of incompetence and have nowhere else to go. I would say she got there at the Fed, how she got another chance at Treasury, but that's the answer. But Lael Brainerd, I'll say, is more talented, and hopefully she'll be. So they'll throw Yellen under the bus, blame her. By the way, that's the Biden technique: deflection and denial and just blaming other people. So they'll blame her for the whole thing. She probably doesn't see that coming, by the way. Maybe she should tune into London Real. And then they'll put Lael Brainerd over there. But Mary Daly was on the short list to fill Brainerd's seat at the Fed. Well, you can forget that she can't get the hearing at this point. But she was running around on, climate change, social justice, George Floyd, BLM. And again, free country, you want to express a view, be my guest, but not as chief regulator of Silicon Valley Bank.
Yeah. It's so should they have let it fail? And what would have been the carnage, Jim, if they had?
Well, again, this hindsight. You shouldn't have been allowed to get to that place anyway. But there might have been more. This is where there's a lack of creativity. It's kind of all or nothing. It's like, oh, if this fails, we're going to have a wave of failures of startups in Silicon Valley. Well, that's probably true. Probably true. But most of them fail anyway. If you know the venture capital business, and I'm sure you do, most of these things fail anyway. A couple of winners here and there. Well, how difficult would it have been? So now you're the entrepreneur. You had $5 million of working capital, which you got in a round, an angel round or whatever from some venture capitalists in Silicon Valley. You got some premises, you got a payroll, you got some developers, you got employees, all that stuff. And now your cash is frozen. Not just frozen, but gone. You got to go yang money, you got a due bill from the FDIC. Now who's to say if those companies were well run and they actually had some good technology, how difficult would it have been to make a few phone calls and say, you know what, we're stuck in this thing. I need a 2-year bridge loan, or I need a 1-year bridge loan. And I'll collateralize it by the proceeds of my receivership certificate. And as and when I get paid, I'll pay down the loan. We can have a simultaneous closing. All good. You could have got money. Some of those firms could have got money. Some of them not. Maybe some layoffs. Maybe they would have failed, but most of them do anyway. I mean, that's my first point. But that was not the majority of, and unemployment would have gone up. I mean, I'm not saying that there are no hardships, Brian, but we gloss over the greater hardships on the economy as a whole. And that gets to the other lie, which was Janet Yellen coming out and saying, there's no cost to the taxpayer. Like, wait a second. Because you mentioned the bailout of the Fed taking the loans below market value and giving them, at market value and giving them par value, which is more for 1 year, and glossed over that whole thing. But there was a separate bailout, which is the FDIC guaranteed every penny of every deposit in all those banks. Well, when you look at the numbers, you have grossly depleted the insurance fund. The FDIC is an insurance company. That's what the I stands for. And they have reserves, just like every other insurance company. They charge premiums. That's how they go. This would have basically wiped out the reserves. So how are you going to top up the reserves in the FDIC for future bank failures? Well, they said, we're going to raise premiums on the banks. Okay, they are. But what do the banks do? Well, they're going to either pay you less interest or charge you fees. In other words, the bank isn't just going to sit there and write checks to the FDIC and watch their P&L evaporate. They're going to pass the cost on to the customer, which is us, which is the American people. So does your tax bill go up? No, but your interest rate's gone down, or your banking fees are going up. So the cost is shifted to everyday Americans. So don't tell me that we're not paying the bill, because we are. So again, these are in the nature of government lies to kind of, disguise what they're actually doing. I don't have $100 billion, so maybe there's a level where you got enough money and it's not your primary concern. I like making money, but it's not what the first thing I think about when I wake up in the morning. The first thing I think about is how do you solve problems and what's going on. It must seems to have some of that, maybe more than a little. Look, if you don't have free speech and you abandon the Constitution, I mean, is this like the fall of the Roman Republic? I mean, there's a little bit of a uncomfortable resemblance. Again, going back to what we said earlier, you got to study history. It's certainly not the same, but there's no better playbook for doing analysis than a really good understanding of history. It's why today in America, and I would say not just communists, but neo-fascists and other forms of dictators, and we have plenty of those in Washington. One of the first things they kill in the curriculum is history. They stop teaching it, because if you knew a lot of history, you'd see these things for what they are. But I have some pretty good history teachers, and I've always been interested in it. So I was shocked by what's revealed, even though I've been around enough to maybe not be shocked, but just the extent of it and the depth of it. And I have a lot of sympathy for the users who were suppressed and squashed and deplatformed, and even more sympathy for the victims of that kind of censorship.
So we were on the front lines of that information war in 2020. And so when I see these files, I see it from a slightly different angle. I mean, April 6, 2020 We had the second largest YouTube live stream in the world that day, Jim. 65,000 concurrent viewers watch me in this studio have a 2.5 hour conversation where things were questioned as far as efficacy of a PCR test, masks, future vaccination policies, which were really early. Even origination of the virus might have come out of Wuhan, something they'd literally almost lock you up if you had mentioned that in April of 2020. 30 minutes after that, Jim, for the first time in my 9-year history of London Real, a video of mine on YouTube was deleted and banned. And I thought, what is going on here? I thought the weirdos are the people that got censored in this world. And then after that, I was subsequently banned, shadow banned from the following platforms: LinkedIn, Facebook, Instagram, Dropbox, PayPal, right? With 6 figures of balances on PayPal. Dropbox, where I didn't think they were watching my videos. I mean, that's technically my information. And again, I'm not a conspiracy theorist. I leave that to the guests on my show that come on, because I think they have the right for free speech and we should all listen to what they have to say. But when I saw those Twitter files for the first time, Jim, I thought, okay, if there was a coordinated effort, it would have to come from a single source. And why not come from someone who's trying to say, please, can we stop people talking about X? So I saw it in a slightly different way, to where I was like, oh, okay, now I could see maybe how that coordination could happen.
And I like the way you put it, Brian. You said with this guest, this particular show, you were questioning things. You weren't being categorical about this. You say, well, maybe it did come from Wuhan. And that's what you're supposed to do. My book, the New Great Depression, came out in January 2021. Interestingly, the publication day was delayed because of the supply chain, which was my next book. But I had it pretty much done by the summer 2020. And what strikes me was the evidence was there then. Now, 2 years later, you're watching whatever, Tucker Carlson or, Alex Berenson or others. I'm sure there are many in the UK. And they're saying, do you know that the masks don't work and the lockdowns don't work? And this thing looks like it came from Wuhan. I was like, yeah, I do. And I said that in 2020, but the point is the evidence was there. It wasn't guesswork. I'll give you a real quick example. The leading epidemiologist for virologists of the 20th century, maybe all time, is Dr. D.A. Henderson. Now, D.A. Henderson's not a household name, but if there's a single individual most responsible for eradicating smallpox on the planet Earth, it was D.A. Henderson. He won the Presidential Medal of Freedom, which is our highest civilian honor, equivalent to the Congressional Medal of Honor in the military, dean of the Bloomberg Johns Hopkins School of Public Health. I mean, you can't go any higher in the profession, have more respect than D.A. Henderson. He wrote a paper in 2005 that said lockdowns don't work. And he had the research to back it up. This was at the time, I believe it was the swine flu was going. There was an avian flu and a swine flu during the Bush administration. Bush was actually very concerned about it. And Henderson wrote this paper, said they don't work. And I cited that in my book. But the point is, we didn't have to wait until 2021 or 2022, in China's case, today, to find out that lockdowns don't work. In 2020, we had a paper from 2005 that said the same thing. He said, if you have an island and there's no airstrip and only one way in or out, and you got 100 people, maybe, but that's not North America, that's not Europe, that's not the world. They just don't work. Well, if we knew that from the leading epidemiologist, maybe of all time, why didn't we follow that advice? Well, the answer was it was a hidden agenda. They wanted to shut people down. They wanted to basically we empowered the inner fascists in all these government bureaucrats. It was Black Scholes, it was Fisher Black, Myron Scholes, but there was a third contributor, and he won the Nobel Prize, which was Robert C. Merton. Merton was at Harvard, and Fisher and Myron had worked on this for a long time and had come close, but weren't all the way there. They went to Merton to help with the math, actually. And Merton solved the math problem for them, but to his credit, and very generous, and another really nice guy, he said, look, you guys go ahead and publish this, and then I'll tag along a few months later with my contribution. And the Nobel Prize is not awarded posthumously. So Fisher Black sadly died before they got the prize. So Merton and Scholes won the prize. And again, to their credit, they pulled the award divided by 3 and gave 1/3 to Fisher's widow, which I thought was very, appropriate and very generous of them. But it was a math problem. You write about what they call Brownian motion, which is random, and so it was sort of, you had a fan, if you will, of probabilities, and then different degree distributions, some more likely than others, etc. Having said that, and the success of Myron used to say, Jim, if only I had patented the idea and had like a fraction of a penny on all the notional value, I'd be the richest man in the world, which is probably true. Yeah. But they didn't. They put it in an academic journal. But there are assumptions in Black-Scholes which you can question. I'm not dinging the model. Science is always, hey, let's make it better. It doesn't mean you don't use what you have. But they assume a risk-free rate. Well, is there really anything, is there a risk-free rate? Is the United States risk-free? I don't think so, actually, and it's getting riskier by the day. So you can kind of question that assumption. Does the future resemble the past with some probability, some degree of distribution probability? Not always. I mean, and maybe less frequently now than ever. And they also assume that prices move continuously. Prices go up and down, of course, but that you could get, if it were going up, you could get out of certain levels. If it were going down, you could put stop losses on your position and get out of certain levels. You could manage it. And of course, that was a big contributor to the 1987, October 19th, 1987 flash crash, when the market fell 22% in one day. I mean, today we get worked up if it's down 22% in a year, which it was last year, approximately. But this is 22% in one day. But it turns out none of that's true. Markets don't move continuously, or if they do, it's when you don't care. When you do care, they just gap. They gap down or they gap up. You miss it, you blink, and it's at a completely different level. It's been repriced. Now, you can still get in and out, but you've either made a lot of money or lost a lot of money, in the blink of an eye. So when you take those characteristics, and this is how I started kind of, deconstructing it, if you will, and say, well, look, markets are not efficient. That's nonsense. They don't move continuously and slowly. They gap up and they gap down. And if you're not ready for that, you've missed the boat. Nothing's risk-free. So why don't we start there? When I started identifying those factors that, in my view, were incorrectly applied in long-term capital, but really everywhere, and you say, well, what looks like that? Well, the answer is a complex dynamic system. A system that produces hurricanes and tornadoes and lightning bolts and power outages and earthquakes and tsunamis. Those are all examples of the results of complex dynamic systems. An earthquake doesn't sneak up on you. It just the ground falls out from under you instantly. And that's what happens in markets. So then I said, well, maybe that's a better model. Of course, it is. So, very good point, Brian. So let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy. No reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we moved. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you have to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, they forget the name. Well, the particular name of the bank, but they back one of the stable coins. Actually, it's USDC. Yeah. Had $3 billion in Silicon Valley Bank, and they talked about all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. Yeah, in the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people. So almost nobody knew at the time except the management, although they seemed to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses. And by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. Brian, so let's go back to Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. that played out. The intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy. I know no reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we moved. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. One of the big crypto promoters, they forget the name. Well, the particular name of the bank, but they backed one of the stable coins. Actually, it's USDC. Had $3 billion in Silicon Valley Bank, and they talked about all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money up, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank, and they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out in force. Bill Ackman, all these guys. Oh, you got to save us. I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people. So almost nobody knew at the time except the management, although they seemed to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's the way, if you're looking at these big banks or any institution or your own savings institution to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, the chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years. But they're working on it. Wind turbines. Other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses. And by the way, we are in an election cycle here in the United States, but from the greenies who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night at 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. The math and the science behind diversification and why it's a good strategy is very clear. That's not much debate about that. The problem is people don't understand what diversification means. They think if they have 50 stocks in 10 sectors, semiconductors, consumer non-durables, or whatever, they're diversified. And what I say to them is, you may have 50 stocks, but that's one asset class. You're in stocks. And in stressful situations, they become highly correlated. So you're not getting the benefit of diversification. You think you are, but you're not. So what does a diversified portfolio look like? Well, I have a slice of stocks. I'm not anti-stock market, but you got to pick the sectors and the stocks that will perform well, even in the kind of conditions we're talking about. And I would go back to energy, natural resources, agriculture. So, a Marathon, ExxonMobil, Chevron, ADM, Cargill, mining companies, and not just gold, but I recently invested in a lithium mine. The Green New Deal, I call it the Green New Scam. It's a scam, but it doesn't mean it doesn't have legs, whether you like it or not. The fact is, it's going to go on. So the lithium's in short supply, graphite, et cetera. So there is a portfolio you can have, which is natural resource oriented, that will do well, even in the kind of tough environment we're talking about. Slugger cash, absolutely, maybe as much as 30%. I like treasury notes, 10-year treasury notes, but season to taste. If they're a little too volatile, look at 5-year notes, 2-year notes. They're going to come down a lot, not right away, not tomorrow morning, but sooner than later, because of everything we discussed, which is recession and interest rates will follow. They're a lagging indicator, but that'll happen.
Bonds, particularly the sovereign bonds, especially the U.S. Treasuries, they're looking the best they've seen in a long while, and relatively recently, some have said it's like the best I've seen in my career. So I'm just curious, do you find that compelling for the moment in time we're in here?
Absolutely. There's hate to get too deep in the weeds in terms of bond math, but there's something called a DV01. DV01 is the dollar value of 1 basis point. What that means is, obviously, basic bond math, interest rates come down, the price of the bond goes up. They're just inverted. It's a little counterintuitive, but the question is how much. And the lower the interest rate, the more the price of the bond goes up for every basis point drop in rates. So in other words, if you go from 9% to 8%, you'll have a nice capital gain on your bond. But if you go from 3% to 2%, it's still a 1% drop, but you're going to have a much bigger capital gain. In each instance, it's a 1% drop in rates, but the amount of capital gain on the bond is much higher. The DV01 is higher when the rates are lower. Again, it's all counterintuitive. The lower the rate, the greater the capital gain on each basis point drop in yields. That's the basically. So yeah, when you go from 3% to 2%, that's a home run in terms of capital gains. So you get the yield, you get the safety, you get the liquidity, and if you feel like selling it, you got a nice fat capital gain. Gold, I always recommend 10% slice. But based on what we were talking about, I would get silver dollars, American Silver Eagles. The Monster Box, that's a bit of jargon. Monster Box comes from the U.S. Mint. It's Treasury green, nice shade of green. It comes with a compression strap. I recommend don't open it, unless do not break except in case of fire. But inside are 500 1-ounce American Silver Eagles. That's a lot. They'll feed your family for probably a year. It's a market price, be around $10,000, $12,000 for a Monster Box. But to me, it's like battery and flashlight. I like them both. And, I talk about gold a lot because it's a form of money, and I do the monetary analysis. I do invest in gold mines, but I don't hold myself out as a geologist, but I do think about it from a monetary perspective. And then people always say, Jim, what about silver? What about silver? I'm like, look, if gold soars the way I expect, silver's along for the ride. There's not going to be a world of $3,000 gold and $20 silver. That world doesn't exist. If gold's at 3,000, silver's going to be pushing 100. So without giving an exact forecast, silver will be along for the ride. Silver is a little more difficult to analyze because it has industrial applications. Gold really doesn't. Gold's not good for anything except money, but it's the best form of money. Silver is used in a lot of applications. So if you have a recession, it's perhaps the case that the monetary value is going up, but the industrial input value is going down. So it's a little bit more of a mixed bag, but silver is going to do fine. And I do think it's extremely practical because in a world of CBDCs, silver will be a form of spending money. Gold, even the 8-gram coin I mentioned, the quarter-ounce American Gold Eagle, still $500. It's like pulling a $500 bill out of your wallet. It's a lot for groceries. Home prices are coming down a little more in some markets than others, but if it's income producing and it's solid and it's a place like, someplace people want to be, like Austin or Phoenix or whatever. I mean, I know there's markets down a little bit right now, but it's like buying a 10-year bond. It's got steady monthly income and or certainly farmland. But income producing real estate, not commercial office buildings, should be a part of a diversified portfolio. Yes. I like private equity, and it's, you got accredited investor issues and finding good deals and good promoters and good management. But, some good deals in the mining sector I like. Well, that would be one.
I wanted to talk to you real quickly about the current state of media. I'd just love to hear your thoughts on this because I know this is something that you care about, that you've written about a bit. And you're playing a role in trying to give people, more accurate, more nutritious, more actionable information than what they're able to get from the news sources that they're just directed to by society.
If you talk about what they call legacy media, mainstream media, so Washington Post, New York Times, LA Times, NBC, ABC, CBS, MSNBC, CNN, that run of characters. The first thing you discover is, I know a lot of these people. I've been on all these programs. I know this for a long time. I spent a lot of time in Washington, had dinner with most of or lunch or whatever, dinner actually more often with most of the names you've heard about. Some of them are fine, some of them nice. A lot of them are either not that bright, or, they're good on camera, or whatever. They got a desk at the Washington Post. They're not that bright. Or if they've got some degrees, they've been kind of indoctrinated. We're at the point now. A lot of these people are 28, 33, 34 years old. There's nothing wrong with that. That's, good. You're in the heart of your career. But that means they graduated from school in, 2016, 2017, or whatever. And they're thoroughly indoctrinated. I went to school when we learned, it was pretty rigorous. I had one program where they graded, you needed a C+ average to graduate, but they graded on a C- curve. So you're like, how do you get it? How do you even get a C+ if they're grading on a C- curve? The answer is people quit. In other words, you were trying to struggle to be. I did get an A in partnership taxation, and I'm proud of that. But the standards are down, the emission standards are down, affirmative action takes over. When you get into the classroom, I don't care where you're at, Ivy League, whatever, it's just indoctrination. The market has a way of sorting it out. If revenues are down, advertising's down, viewers are down, subscriptions are down, eventually they will go out of business, not overnight, and then new media channels will arise. And there's a lot of garbage on the internet, but there's a lot of good stuff. And if you want to keep tabs on the war in Ukraine, you have to know where to look. It's not easy, but there are a number of channels and I'm talking about military officers, colonels, brigadier generals, people on the ground in Ukraine, not some studio in New York. You can find out what's going on, but I think my intelligence training is helpful because you have to be very persistent and know how to dig. If you look at yield curves, look at the Treasury yield curve, Euro-dollar futures yield curve, German Bunds yield curve, they're all inverted. They're all inverted. Now, inversions happen, just meaning the longer-term rate is lower than the short-term rate. We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no, this is bad and it's going to get worse, and it's actually too late for the Fed to do anything about it. See, when these inversions start, sometimes they're a year forward, like, hey, look at the Eurodollar futures yield curve a year from now, man, that thing is inverted. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Okay, whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. And then corporate yields will go up a lot because of the recession, because of deterioration, increased bankruptcies, reduced revenues, et cetera. So those spreads will blow out. And it's important to remember, interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. The yield curves I was talking about are very good forward indicators. They tell you what's going to happen next. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is, if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. Instead, I'm going to borrow everything I can. And that creates a demand for funds, and interest rates go up. And then the recession hits, and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. Interest rates peak after the recession has already begun. So interest rates may not have peaked yet. Even the treasury market. So that's not unusual. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statute, SEC. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. the fall of 2008. I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level.